Hi, this is Natalie Pace. We're feeling pretty hot over here, even though our prayers are out for anybody who's enduring this winter storm. Why is that? Because our silver fund tripled. Our copper fund, actually, we leaned into Peru, not just copper, doubled. And even our clean energy fund was up almost 60%. Now, that's way better performance than the Magnificent Seven, which, of course, we also had not just in our large cap growth, but also an extra hot slice of it. So, how can you get hot in your portfolio? That's going to be the focus of this video conference today. Of course, we're also going to talk a little bit about safety. And I got a great question in the Money Show this morning when I was doing it from a younger person about how they can do their money better. And I have a great tip for that. So, we'll be talking about all this and more. And get started in just a moment. Okay, so I'm going to show you my PowerPoint and I'll come back and talk to you as well. So I just told you a little bit about why we're feeling so hot. Those are the, now I also want to mention that, look, in general, I haven't been including a lot of individual stock picks. And the reason for that is that with equities so expensive, a lot of people can get into a lot of trouble by trying to invest in individual companies. A fund having, a bunch of companies in one, entity like a fund, an ETF, that is going to protect you because if one company gets into trouble, the 99 others are going to keep it more buoyant. So that is why I haven't been doing that much. I only did three stock picks last year. First Majestic Silver, that one shot the moon. McEwen Mining shot the moon, and Archer Aviation, which we still think can really do well, especially leading up to the 2028 Summer Olympics in LA, where they are the official air taxi. So I just wanted to say that is that we did have two out of three stock picks really shoot the moon. But it's not going to be right for everybody. Now, here's the official performance card. And again, as I told you, the Peruvian fund is more than doubled, the silver fund more than tripled. And here's what, look, information technology and communication services, that's really the Magnificent Seven. So you can see that, I mean, obviously Google outperformed, but then Tesla underperformed. So these other hot slices that we had were super performers, even though the Magnificent Seven did indeed lead Wall Street. Now, also, I want you to look down here, consumer staples, real estate, energy. Now, these are a lot of the industries that are in our value funds. We are using a value replacement funds, and that in fact, our Peruvian fund is a mid-cap value replacement fund. There are many reasons for it, but you're seeing it in spades that those are the underperformers. And if you compare, what real estate did or consumer staples or energy to what Peru did, it's telling you in spades that our strategy of the replacement funds for value is really paying off. It's giving us country diversification, it's giving us performance. In a lot of cases, we even get a higher yield and sometimes even less risk. We'll talk about that a little bit more as we go forward. So again, remember that investing in an individual company is really not right for a lot of people because you can't just buy and hold. With equities so expensive, we have seen downturns that drag everything down with it. It's not that it's only the bad companies that go down, especially if things are overpriced. And we'll talk about that again. That's going to be a constant theme motif going forward. I do encourage you to watch my interview with Rob McEwen. It's available on YouTube or Substack. You can always email info@nataliepace.com and just ask us directly for the link. But the real news here is that McEwen Copper is going to be launching an IPO. And that's this year. So I do think you want to listen to Rob McEwen talk about McEwen Mining and McEwen Copper and make your choices based on that about which way you want to go with your investment. Also, will these precious metals continue to soar? Could anything ruin the party? What's the best strategy? And also, how do you mitigate capital gains? Just remember that if you're investing in a retirement account, that is a tax protected account. So we want to try to do that. Now, what I do, and this is one of the tips that for that money show question I got asked. This person was like, "Well, how can a young person do this right?" And I said, "Okay, if you have an employer, go with the match. Don't just put all of your money into your 401k. Go with the match because you have less freedom of choice there, but you're getting the free money from your employer. Then try to max out your own personal Roth IRA. You can't invest in Peru or the Silver Fund or any of that. You can't really do that in your 401k. So if you don't have your own individual retirement fund, you really can't do it. And if you do it outside of a retirement account, you're going to pay capital gains. So have that Roth IRA and start building up your own personal wealth. The example that I like to use is that Peter Thiel is a billionaire. A lot of people know his name, and he reportedly has $5 billion in a Roth IRA. He never had to pay capital gains taxes, and he won't have to pay income taxes when he withdraws it. But there's one other investment hack that really works well the younger you are. If you're under the age of 65, you should still know about it. And that is the health savings account. So a lot of us are spending an arm and a leg on health insurance, and we're afraid to go to a high deductible. And of course you would be, because who can afford to spend $15,000 out of pocket? But with the health savings account, that covers that. So what you do is that becomes another retirement account that you can use for healthcare. I encourage you to consider it as a wealth strategy, not keep putting your hand in the pot and taking it out. You can literally save thousands, if not tens of thousands of dollars a year on health insurance premiums. That money that you get to keep, that you can fund your own health savings account to cover that high deductible, and becomes the best long-term healthcare plan, and gives you a tax deduction. It's a win-win-win-win. All right, let's go move on a little bit more. And I did just do a blog on health savings accounts, so you can email us at info@nataliepace.com for more information on that. I'll give you a link to the blog. So what could ruin the party? I think the most important thing to know about safe havens is that when stocks fall, this is from April of 2025 during the tariff scare. In the beginning, safe havens can fall too. They get drugged down. So that's one of the risks. Now, Goldman Sachs says that gold is their favorite precious metal. Mine has been silver for years, and it has really paid off. If you look back at that performance chart, you can see that silver was the super performer. Gold has been great, but silver's been the superstar. Now, copper is slightly different. Now, of course, there's a little risk here. So that's one of the reasons why we always are age appropriate, properly diversified, and rebalance at least once a year. That way, if you rebalance and it drags it down initially, instead of going, oh man, I just lost 20%, buy more at a lower price. You've kept your wealth and you've got the ability to buy more at a lower price. And that's the beauty of the diversification strategy with regular rebalancing. So Peru is the second largest copper producer in the world. EPU is the ETF we were using. The yield was 4% now because the share price has doubled. The yield is only 1.31, but that's still, it's still pretty decent. It's probably not too far under what a lot of the mid-cap value funds in the US are, and they have obviously not performed as well. So it's our small or our mid-cap value replacement fund, but I do get people asking me why Peru instead of Chile. And if you aren't aware of this, Chile's copper mines, even though Chile is the #1 copper producer, they're nationalized. And also, Chile tends to have lower GDP growth than Peru, largely because of the nationalized copper. So other people say, well, what about the labor and the social unrest in Peru? And that's why we are leaning into an exchange traded fund that has a lot of companies rather than one copper company located in Peru. Second thing is that, the Peruvian economy is so closely tied with copper that the politicians and the people themselves have every incentive to figure this out. So yes, the social unrest has affected individual companies, And in fact, that is limited supply, which is what's keeping the copper prices high. So, yeah, look, anytime you're investing in an equity-based fund, it's risk. That's why we keep a percentage equal to our age safe. You can overweight safe if you're worried about it, but you are taking on risk anytime you invest, even if it's in the Magnificent Seven. And again, we got super performance for taking on that risk. So will copper prices stay high? Uh, Supply has been a little constrained and demand is massive. EVs, the power grid, everything is, the increased demand in data centers, all of this is positive for copper. But why is copper called Dr. Copper? And this is a chart that shows you how far it plunged in the Great Recession. And the reason is that if we have a time where the economy pulls back and people stop buying those electric vehicles, right? Or they stop investing in AI, then we could see a plunge. Now, none of that is predicted. Electric vehicle sales are expected to go 12%. The S&P is expected to grow at least 16% in 2026. But I will say that analysts and economists are lousy at predicting recessions, and we do see some bugaboos in the problem, and I'll be talking about that. So again, the best strategy isn't don't invest. It is understand that even though everything's been coming up roses, and the economists and analysts say it's going to continue to do so in 2026, there are things to be concerned about. And there are ways that we can actually protect ourselves while still having game on and feeling hot, hot, hot. So, which countries will be hot? Oh, in 2026, I got to change that. So, again, we're using value replacements for all of our value funds. So, small, medium, and large. You may even have an extra hot slice in there. And the reason for that is that the US has a great deal of debt. We'll be talking about that in a moment. The countries that I've picked have lower debt to GDP than the US, massively lower, much, much lower. And some of them have much higher growth, not all of them. And, they oftentimes are offering a competitive and sometimes even a higher yield. Our large cap value replacement fund has a higher sovereign rating than the US, has typically has higher bank ratings than the US, when there's usually a lot of banks in value funds, and pays a higher yield than the US. So you're getting paid more to take on less risk, which is a very unique position. It's very rare that that happens. Also, and this is another reason why you don't want to just invest all your money in your 401k, is that value funds, target date retirement funds, and bond funds, they're not doing very well. This is the PIMCO over a bond fund, bond exchange traded fund over the past 5 years, and you can see that it's lost 17%. So they're not doing that great. And that's part of the reason why you really want to know what you own and you have these multiple accounts so you can get hot in the Roth, and you're going to have to figure out how to get the best investment possible in your 401k, but not just rely on these target date retirement funds. Also, if you have a managed account, most managed accounts are you're charging you either 0.5% or up to 1.5%. So you could be paying thousands of dollars to lose money. And if you have paper losses and a managed account, I think you should be coming to our retreat or getting an unbiased second opinion from me. So again, this is a target date retirement fund. That's that blue line, 5%, 1% each year over the last 5 years, compared to, this is just the S&P 500. And that one is 83% over the past 5 years. So paper losses can become real and substantial. And we are having no paper losses in our fixed income strategies. I just I need to tell you this, then I'm going to tell you another thing. So many older corporations are carrying very high debt, very low credit quality. Over half of the S&P 500 is at or near junk bond status. That includes energy company, banks, and many companies, again, that were founded in the 20th century. The higher the dividend, the higher the risk. I'm talking more about getting hot in this video conference. It's not our fixed income video conference. But what I will say is I just did a bond and fixed income masterclass. And if you register for our April retreat by the end of January, January 31st, that's this coming Saturday, you can ask and I'll give you that as a free gift as well. Okay. But that's really important to know it's safe in a debt world. So this is our debt world. If you'd like the asset bubble chart, then just email info@nataliepace.com and ask for it. You can look at it more closely yourself. And you'll learn what this means more if you attend our financial freedom retreat. Why not learn the life math, that we all should have received in high school? Our life transforms, right? Even just a couple of the life hacks I told you already, within a month, you could be saving thousands of dollars annually and building up the best retirement accounts for yourself. So imagine what I can teach you over a 3-day weekend. So will there be a crypto winter in 2026? There is a strong historical trend with halving events. And this is in 2024, I named Bitcoin the investment of the year. And Bitcoin obviously shot the moon in 2024. It did very well in 2025 up until about October. So, and it's still strong, but I think that what people need to understand is that if and things don't have to go exactly like they did in the past, but if things do go as and this having a historical trend, it's happened like 3 times. The halving event occurs. It occurred April of 2024. A year later is the high that happened in 2025, and then a crypto winter in year two. So anywhere in 2026, April or thereafter, it could start a crypto winter. Now, it doesn't mean that it has to happen, but it has been happening in that kind of a cycle. And the crypto winter is long, 18, it could be 18 months, it could be 2 years. So I think that the important thing here is to understand that it's not expected to be in favor in 2026. And when the crypto winters come, they are devastating. So the last crypto winter was 2022, and Bitcoin fell 67%. By the way, you see that Tesla and the ARK Innovation Fund, where a lot of those Magnificent Seven companies are, they also fell that far. So that happens not because the Magnificent Seven is magnificent. They're overpriced. And we also saw that even in April of 2025, during the tariff scare, it was the Magnificent Seven that plunged and dragged down the S&P 500. The S&P lost 20% in about a month during the tariff scare. Of course, it more than made it back. But I think that this is important to realize is that these companies are very, very expensive. We'll talk about Tesla as one of those. So it's not expected to have an EV winter in 2026, but sales are slowing down a little bit. So sales of EVs are expected worldwide to increase about 12.5%. The majority of EV sales are in China. Tesla's very popular here worldwide, China. The car, people really love the car. The problem is that China has a lot of competitors that are lower priced, and they actually are able to sell them in countries like Mexico. I've heard that even Canada is going to be buying some of the Chinese EV vehicles. Um, Europe, some European countries do, some don't. So it's just important to understand that Tesla has competition. They had to lower their sales prices. That has impacted their net profit margins. We're going to talk about that as well. But it also impacted their sales. So their Tesla deliveries in the fourth quarter were down 16% year over year. They're going to be announcing their earnings on Wednesday. That's tomorrow after the markets close. And they probably will have less than $5 billion net income for the year versus 15 billion 2 years ago. This is a company that is going to have a $5 billion net profit for 2025 that is worth $1.45 trillion dollars with a 302 PE. That is a very outlandish evaluation. That's very, very high. And I know that people say, oh, well, it's got AI and it's got all these robots and it's going to be doing robo-taxis and all this sort of stuff. It definitely has a great future ahead of it. The problem is that when you price it out 5 years from now, if we have a recession that lasts 18 to 24 months, where Tesla loses 67% like it lost in 2022, you are left holding the buck and the bag for a great deal of time. Your FICO score plunges, your wealth plunges. So it's a better idea to always, have that diversified plan in place. Okay. And this is very, very expensive stock. So, and I'm not going to go through this a lot here because I understand that, I may lose you by paralysis by overanalysis, but I want you to know some of the risks. So VIX is low. That means consumer sentiment is strong. Everybody still believes in their stocks and their Magnificent Seven. But we are seeing some cracks in the economy, especially in lower and mid income. So the consumer sentiment is very low. That's really low. That's highly correlated with recessions. The K-shaped economy, we're seeing a very big spike in the amount of delinquent debt. So all household debt is about just under 10%. You see that student loans, delinquent student loans, mortgages, right? There's a lot of debt. Also, stocks are very expensive. The only time they've been more expensive is .com. They're even more expensive today than the Great Depression in 1929. In the .com recession between the high and the low, it took March of 2000. The low was October of 2002. It took 16 years to come back, and the Nasdaq fell 78%. That means that $1 million went down to $220,000 and you didn't really recover for 16 years. And that's why we want to not just believe, oh, AI, yes, AI, have a hot slice, right? Have an age appropriate, properly diversified plan. We're going to show you in a moment what that looks like. Also, one other risk is that midterms perform poorly. As you can see here, both the 2022 and 2018 were down years. Those are both midterm years. So this is what an age-appropriate, properly diversified plan looks like. Keep a percent equal to your age safe. If you're worried that stocks will go down, overweight safe. And then the at-risk side, that's where we had our Peru and silver and small, medium, large value growth, four hots, right? Silver, Magnificent Seven, cybersecurity, clean energy. That's where you can get your performance. But again, if you only have a 401k, you're not able to do it. So that's why it's super important to have your own Roth IRA too. All right, so this is one for someone who's older, right? A 50-year-old would have a 50% safe. And again, look at all the expository I have on the safe side. It's that important. We spend one full day on what's safe at our financial freedom retreat. But the good news is, even if you're young, you want to know about it because 3.5% yield on $1 million is $35,000. That's a lot of extra money every year, right? Oh, I only have 500,000. Okay, that's 17,500, right? So you want to be earning that yield, but you don't want to be having paper losses to get it. And we've been very successful at navigating that. So again, you can get safe, hot, and protected in one easy plan. You can do dollar cost averaging if you are trying to get into some of these funds that I talked about that have already shot the moon. We can talk to you about how to do that at the retreat or in my private coaching. And then once, twice, or three times a year rebalancing is really a very good strategy, at least annually. And now, if you haven't ever done it, is perfect because stocks are at an all-time high. So you'd be capturing gains at an all-time high. A couple more quick things to tell you about. So email us. You can personalize your own sample pie chart with our free web apps. Email info@nataliepace.com and just ask for your free web app. Also, I have blogs, money tips on social media, video conferences, quarterly retreats, and I have an unbiased second opinion in my private coaching. So here's a blog, and again, I have my other blogs of interest at the bottom of each blog. So if you're looking at, the blog that I just wrote and you just scroll down to the end of it, you're going to get a list of all of the blogs. So the most recent one was about mortgage rates, right? But I also have one, I'm just going to do a quick one on healthcare because I did one about how to save thousands on health insurance, that health savings account that I told you about. Also, you can find out how to follow me on social media, where you get your daily money tips, or how you can listen back to my Substack or YouTube. And of course, I just did, if you know anybody, parent or teen, even somebody considering graduate school, I have the second edition of the ABCs of Money for College just came out. So visit nataliepace.com and get on our list. Email info@nataliepace.com and get on our list. And this is our next retreat. It's online April 24th through the 26th. If you register by January 31st, you'll get a private coaching session, and that's got a value of $400. You can also ask for the masterclass of your choice. So if you're interested in the bonds fixed income one, great. If you're interested in any one of our other master classes that we've already had, I'm happy to give you the link to it. All right, so that's it for today. Remember to, follow me on social media. Be sure you're following me on YouTube and Substack so you're notified whenever I do a new video conference or a new interview. And thank you so much for your support because that allows me to do this job that I love, which is adding a splash of green to Wall Street and transforming lives on Main Street with the news, information, and education we all need to lead a rich and green life. Thank you.